Good morning, doctor and everyone. We are from Group 4. My name is Gui Kejun, and this is my group member, Ko Jia Hao, Li Kai Ping, Ko Chien Wen, Chong Mun Yi, and Carmen Tan Kerwen. The first investment product that we want to introduce is unit trust. Unit trust is a collective investment tool where the funds of multiple investors are pooled together and invested by professional fund managers. Then the professional fund managers invest the pool fund in a portfolio of investment. In Malaysia, unit trusts are also known as mutual fund or trust fund. Investors participate in an investment by purchasing units instead of directly purchasing securities in a portfolio. The total asset value of the fund affects the value of each unit, so the number of units that an investor holds depends on the amount they invest and the purchase price of the units. Investment return of unit trusts mainly occur in two forms: income distribution and capital appreciation. Income distribution defined as the portion of a fund's earning from its investment portfolio that is distributed to investors. Capital appreciation defined as the portion of an investment where the gains in the market price exceed the original investment's purchase price. The first characteristic of unit trust is collective investment. Unit trusts bring together the funds of many investors and are managed and invested by professional fund managers. Through pool investment, investors can participate in a larger and diversified portfolio with less capital. The second characteristic of unit trust is diversification. Unit trusts invest in a variety of asset categories such as equity, bond, real estate, money market instruments, and others. The diversified investment strategy helps to buffer market volatility and ensure that fluctuation in individual investment has a minimal impact of their overall return. The third characteristic of unit trust is professional management. Unit trusts managed by professional fund managers that use their expertise and market analysis skill to make investment decisions and asset allocation. Here are some of the common types of unit trusts. First is equity funds. Next is fixed income funds, balance funds, money market funds, real estate investment trusts. There are some advantages of investing in unit trusts. First is there are many unit trusts to choose from, and it's managed by a financial professional. It helps you to easily diversify your investment, and no obligation of fixed investment term required. Whereas the disadvantage of investing in unit trusts are principal investment is not guaranteed, and the performance of the unit trust depends on the fund manager, and the tax treatment of fund is more complex. Here are some of the general risks associated with investing in unit trusts. First is market risk, which may result in volatility of the net asset value due to changes in global economy, political or market conditions. Second is liquidity risk. For unlisted funds, redemptions can only be made on the fund's trading day, while listed funds may also face liquidity restrictions when trading in secondary market. The second investment product is fixed deposit. Fixed deposit is a type of bank account in which you deposit an initial opening value for a fixed period of time. The majority of banks in Malaysia provide terms of at least 1 month or up to 5 years with interest only being paid at the end of the investment period. For example, an investor invests 1,000 ringgit in the fixed deposit with 3 years at 3% per annum. The total interest earning will get is 90 ringgit. The first characteristic of fixed deposit is principal investment. For different banks, get the different minimum principal investment, at most is 1,000 ringgit. The second characteristic is annual interest rate. For different banks, get the different annual interest rate around 1.7% to 3.7%. The third characteristic is placement period in month. Investor can invest at least 1 month or up to 5 years. Fixed deposits are classified into different types based on their characteristic. For example, short-term fixed deposit, long-term fixed deposit, Islamic fixed deposit, foreign currency fixed deposit. The first advantage is fixed deposit give guaranteed returns. The second is fixed deposit give higher interest rate than ordinary saving accounts. The third is fixed deposit are virtually risk-free for smaller deposits. The disadvantage of fixed deposit is there are other forms of investment that give higher returns. The second disadvantage is cannot top up more money into a fixed deposit. The third disadvantage is fixed deposit will not yield any benefit if you withdraw early. Risk that will face when invest in fixed deposit is inflation risk. If the inflation rate is higher than the fixed deposit interest rate, your purchasing power will decrease.
Now I will discuss about bonds. Bonds are debt instruments where investors lend money to government or corporation for a specific period at a fixed interest rate. The insurer will pay the principal amount along with the interest. How the bond function? Bonds are issued in specific terms including the interest payment, which called coupon rate, and maturity date. The initial price is usually set as a par value, but market price fluctuated. There are three types of returns on bonds. The first one is coupon yield, an yearly interest rate that is fixed at the time of issue. The second one is current yield, calculated by dividing the annual coupon payment by the bond current market price. And the last one is yield to maturity. It is overall interest rate if held until maturity. Now let's discuss about the characteristic of bond. The par value of bond is nominal value which is repaid at maturity and used to determine interest payment. The maturity date is when the insurer repay the principal. The coupon rate is the interest paid predically based on the bond face value. Bond yield is the return calculated by the dividing an annual coupon payment by the bond current market price. The bond price is the current market value influenced by various factors. Next, there are many types of bonds such as treasury bond, corporate bond, high-yield bond, floating rate bond, zero coupon bond, and municipal bond. Furthermore, bond provides several advantages. Bond offer a guaranteed return, providing non as predictable income compared to equity. Bonds are considered lower risk than stock, offering diversification and protection against changes in the market. Additionally, some bonds like municipal bond can offer tax-free return. However, the bond also have disadvantages. Bond price will decrease when the interest rate rise. This can affect the value of the investment. Compared to stock, bonds usually offer the lower returns. Besides, inflation also can reduce the purchasing power of the fixed interest payment and principal. When investing in bonds, be aware of several risks. The first one is interest rate risk. Price fall when the rate is rise. Inflation risk reduce the purchasing power, and call risk, which is insurer may repay before maturity that affecting the return. Next, I will discuss about real estate. Real estate included land and any permanent structure like houses and buildings. Additionally, real estate involved in the right to use, manage, and dispose of the land and its building. How the real estate function? Real estate involves legal responsibility in the market divided into development, investment, and management. Each role involves specific goals, risks, and the benefit. Return from estate are come from several resources, which is rental income, appreciation, tax benefit, and equity build-up. Characteristic of real estate is scarcity. Scarcity of land, limited availability, especially in prime locations. Improvement, which increase the value. Location has a big influence on property value, which attract region selling for the more money. Investment permanent reflects real estate long-term stability, offering consistent cash flow. Immobility makes real estate less liquid, however, it remains a strong asset no matter market fluctuation due to its resistance. There are four main types of real estate. Residential real estate comprise development land for housing. Commercial real estate facilitates business operation. Industrial real estate support industrial activity and undeveloped land, whether for future development or alternative use. Investing in real estate offers several advantages. Firstly, it's often easier to understand, and it is tangible and familiar. Additionally, real estate can produce significant profit in an efficient market. Moreover, it can be financed and leveraged efficiently, enabling significant purchase with a small initial investment. However, real estate invest also has disadvantages. The transaction cost is higher, effect on the investment value. Besides, real estate also low liquidity. It is difficult to sell quickly without any losses. Additionally, management and maintenance require ongoing effort and expense. There are several risks associated with real estate investment. Market risk, fluctuations in property value and rental income due to economic conditions. Location risks, property value change in attractions of neighborhood. Next, operational risks in real estate investment involve challenges in property management, such as maintenance issues, tenant conflicts. The last one is financing risk, refer to the potential for financial loss due to the unfavorable changes in long-term or interest rate. In conclusion, to choose the best investment product, it is depend on our personal financial goals and risk tolerance. Fixed deposit and bonds suitable for investors seeking stability and guaranteed return. Unit trust provided diversification and professional management for moderate risk takers seeking for higher return. Real estate offer long-term appreciations and rental income but require significant capital and management. That's all from our team. Thank you.